It's a big week for Wall Street. The Fed is set to release its first round of stress test results on Thursday. They're used to determine whether or not the largest U.S. banks could weather a major crisis. Here with more on this is Hal Scott. He's a professor at Harvard and just wrote the new book, Connectedness and Contagion. Professor Scott, thanks so much for joining me today.
Happy to be here. Thank you.
So the Fed is set to release its stress test results minutes before the UK polls close on the Brexit vote tomorrow. What do you expect from this year's results?
After the 2008 crisis, we greatly increased bank capital. That's good. It's now around 15% of equity for the largest banks. But in a financial panic, if there was a run on the financial system, which is really the story of my book, 15% of capital is nowhere near enough to withstand the effect of a run on a financial system. And unlike 2008, where the Fed had very strong powers, as did the FDIC and the Treasury, to stop a contagious run, we're much less able to deal with that now because those powers have been restricted under the rubric of we don't want to bail out Wall Street again.
And the Fed recently determined that 5 of America's largest banks, and those include Wells Fargo, JP Morgan, State Street, Bank of New York Mellon, and Bank of America, that they don't have credible plans to go through another bankruptcy. What happens if regulators aren't satisfied with their wills?
They would, if they did not have enough money to fund withdrawals, they would be basically insolvent, and people would lose their money. By the way, this is not just a problem for banks. You know, 2008, it was the non-banks, the broker-dealers, the money market funds, and capital requirements that have been set by the Fed don't apply to them. So really, we should be just as worried about the non-banks as we are about the banks.
And which bank do you think is under the most pressure tomorrow on Thursday?
There's no particular bank that's under particular pressure. This is more going to be a system-wide issue if there's a problem at all. By the way, I think that the probability of a panic is extremely small, whatever the vote, okay? And my only concern is, although it's extremely small, if there were to be one, the impact would be very, very large. And so, unfortunately, I don't think the United States is in the position to deal with it as well as it was actually able to do so in 2008.
And this year, the Fed threw in an additional challenge for banks assessing their ability against negative interest rates. Does this new step make more banks at risk of failing?
Well, negative interest rates, if it actually, hit depositors who were now going to have to pay the banks to hold their money, what those depositors would do would be take their money out and put it under the mattress. And indeed, we'd have a new business opportunity for storehousing cash, because people would be better off having cash in a storehouse than having it in a bank where they actually had to pay the bank to hold their cash. Maybe the storehouse would charge a lot less than the negative interest rate. So I think there's really a limit on how far you could go with negative interest rates on deposits. And that then limits the ability of these central banks to use negative interest rates to try to increase inflation and growth.
All right, Professor Scott, thank you so much for joining me today.
My pleasure. Thank you.
And now it's your turn. Do you think bank stress tests are a good idea? Why or why not? Let us know what you think in the space below or on the Yahoo Finance Facebook page.